All right, how's it going, everyone? My name is Amos, and welcome back to another episode of the earnings recap. And we're also going to be looking at the upcoming earnings for this week. If you don't know what an earnings is, it's essentially a publicly traded company disclosing how their performance was for the past 90 days. And if you're invested into a company that is reporting, it might behoove of you to stay up to date to figure out if your investing thesis is still intact or if they have some headwinds coming their way. But before we get into it, let's go ahead and do a quick recap of how last week went. And the first company that I want to revisit with you is Berkshire Hathaway. They reported last week. By the way, this series is different from my usual content. Think of it as more laid back, a podcast format, just two guys hanging out in a jacuzzi. Okay, just think about it like that. We're just talking and conversating about the stock market. So if you're wondering why the energy is low, it's not because I'm sad or anything. By the way, I did get an all-you-can-eat American-style buffet here in Japan. So I do have a little bit of a food coma going on, but other than that, pretty good spirits. But anyways, Berkshire Hathaway, this is the company very famously associated with Warren Buffett. It's a conglomerate. They do a whole bunch of everything. All right, take a look at the description right here. Utility, railroad, insurance, you name it, it's in their belt. My personal favorite brands in the Berkshire Hathaway portfolio include Dairy Queen, which is kind of like a burger and ice cream joint, but also my favorite pair of running shoes, Brooks running shoes. And their earnings, to be honest with you, it looked very conservative. So the highlights, they have right now $344 billion of cash on hand. Friends and family, I don't think there's any publicly traded company that comes anywhere close to the amount of cash in the vault or wallet as Berkshire Hathaway. And I think it's because they're anticipating a huge sell-off or correction happening in the stock market sometime soon. Because in the past and in their history and DNA, that's usually what Berkshire Hathaway does. Usually when they feel like we're in a bubble, they'll start hoarding cash instead of doing share buybacks. That way, when everything in the stock market is 50, 60, 70% down from their highs, they go swooping in and they start buying companies outright or taking majority, stakes. So they'll be the majority shareholder of a publicly traded company of like 30, 40, 50% of all the shares outstanding. But how exactly did their earnings pan out? Well, the profits dropped across the board, including the railroad, including their insurance, and a big bulk from their stake in Kraft Heinz. We always like to associate Warren with having a 100% success rate, but that's just not the case. He does have a lot of home run winners in his record, but he also has a lot of weird, questionable calls like Occidental Petroleum off the top of my head, SiriusXM, and then, of course, Kraft Heinz. So consequently, in their income statement, they did an accounting loss. They wrote down $3.8 billion. Meaning going forward in the future, their assets are also going to be impacted by $3.8 billion. Now, the next company that I want to talk about is Palantir. And by the way, with Berkshire Hathaway, even though their earnings, nothing crazy happened, nothing good nor bad. It was just kind of lukewarm water. You know what I'm saying? Like you pour a glass of water, you leave it out on the counter overnight. I don't know what it is, but I prefer lukewarm water. I know the fan favorite among the the human race, is to drink ice cold water, but I don't know what it is. I prefer lukewarm water. So I'm still just going to wait on the sidelines. I'm not going to jump into Berkshire Hathaway. I think it's a super high quality company. It's kind of regretful that they don't pay a dividend, but I think their track record, the amount of cash that they have in their vault, on their balance sheet, but also the high quality businesses in their portfolio. It's a company that I do want to own one day, but not at its current price point. The next one that I want to revisit is Palantir, ticker symbol PLTR. And if I could just sum up their earnings in one word, it would be spectacular. They reported, here, let's go over their income statement and break it down quarterly. Their revenue for the past 90 days was $1 billion. Year over year, that was a growth of 48%. And if we just take a look at their financial performance of Palantir, 2019 in one fiscal quarter was $161 million. Now, this is exactly what you want to see. When we talk about high quality, right, on this channel, this is exactly what I mean. It does not fluctuate. It's not volatile. It's not ebbs and flows, like a boom and bust type of trend, like they go up and then they go down. No, it is up and to the right and consistently over time, reliable, stable. If we take a look at the growth rate of their revenue, this is what we as investors refer to as a top line. Seeing double-digit growth quarter over quarter, and if we break it down year over year, and year over year like this, I'll still be honest with you, I don't think it justifies having a trading multiple, a PE ratio of a 581, but I can see why their market cap is $400 billion. Because this company is they just defy all the odds. And even up until last year, the beginning of 2024, there were people screaming, shouting, jumping, saying Palantir is fake news. This is not even a real operation. It's all smoke and mirrors. But friends and family, if you want to be a publicly traded company in the US, it is so freaking strict. You have to follow the accounting guidelines and report your financials in a certain format. If not, you're going to get audited, or you might even get delisted from the stock market altogether. This is not a company that is smoke and mirrors. This is probably going to be the next Mag 7 type caliber company. You know how like in the US we have like the Ivy League, right? It's an athletic conference of like Columbia, Cornell. Cornell is not really an Ivy. Yes, I said it here. Harvard, Dartmouth, UPenn. But then you also have the ones that are superior to the Ivies, but they're not in the Ivy. I immediately think of Stanford, Caltech, MIT, whatever, right? In the same vein, that's the exact same way that I think about Palantir. I think they ought to be in the Mag 7. I think the numbers that they're producing, let's see, take a look at their free cash flow. 1.7, oh my goodness gracious. Just look at that, friends and family. For the trailing 12 months, $1.7 billion of free cash flow. That's a growth of 145% year over year. It makes sense. And here's the thing. I want to say that their growth story is a Cinderella one, but I don't think it's going to stop anytime soon because they even raised their guidance for the rest of the year. So if you look at the past 5 days after they reported their earnings, they're up by 21%. I don't think this train is going to slow down anytime soon, especially if you understand the current landscape of how Palantir is being utilized across ICE, Border Patrol, in the airports, and especially in our intelligence agencies. Right now, like Palantir, it's the name of the game. Like their growth story makes way too much sense. However, for me, when the PE is a 600, they're priced to perfection. Meaning, if they have any setback, any narrative that goes against their way, they're going to be immediately punished. And what's really crazy is, back in April, if you dollar cost averaged into Palantir for $74, dude, I don't even know you and I owe you a drink. I'm being serious. If you double down on them for $74 a share, you're probably a very happy camper. I mean, I'll be honest with you, 147% share price appreciation in 8 months. I can see where the hype is coming from for Palantir. Do I regret selling out of them? I bought into them when they IPO'd at around like $9, like right around over here. I sold out of them at 40. I know I tell this story all the time. I thought I was a genius. I 4X'd my money. I was like, dude, yeah. Had I just held on, dude, that night, I think my average cash basis was like $9.75. Dude, 186, 5 years, 2,479%. That's why sometimes they say, actually Fidelity did a study like 10 years ago, the best retail investors are the ones that just do nothing. You buy and hold. Hold through the sell-offs, hold through the dips and corrections. Because in the grand scheme of things, if you have a high-quality compounder in your portfolio, dude, you're going to be you're going to be in the green eventually. Now, obviously, if you're holding into, I don't know, like AT&T or Ford Motors, obviously that lesson doesn't apply. But if you have like Microsoft, Palantir, United Health, I see what you did there. You should be throwing them into that conversation. Hey, stop it. United Health is a high quality compounder. But anyways, if you just hold on to them and do nothing, you will most likely outperform most hedge funds and surely the S&P 500. Anyways, I don't regret selling out of them, but I am absolutely not going to be buying into them at $186 a share either. And we're going to be talking about another company that is on my radar that I think might be Palantir 2.0 because they do almost not the exact same thing, but parallel service. And we'll be talking about them here in a little bit. The next company that I want to revisit that reported last week is the Walt Disney Company, ticker symbol DIS. And how did their earnings go? Well, they missed their revenue expectations by a hair. However, they did beat on the EPS, the earnings per share. So when you think about this number right here, let me give you guys a quick little financial lesson. You jump on over to the financial statements. This is what investors refer to as the bottom line, the net income, the profits that are left over after financing for all the operations to run your business. What is left over? And for Walt Disney, it's $11.5 billion. And then you can break this down even further to each share outstanding. So if you take this number right here and you divide it by the amount of shares that are outstanding, so right now that would be 1.8. Dude, that's a lot. Holy moly. But if you divide it by 11.5 billion by 1.8 billion, then you get the earnings per share. So this is also referred to as the bottom line, aka the profits, aka the EPS, the earnings per share. They beat on this number. And as you can see, Walt Disney is just getting more and more profitable since the pandemic, where their bottom line was negative $1.59. And that's why, by the way, when a company issues more shares and they dilute the shareholders, it's a bad thing. Because fundamentally, then your EPS goes down. Because if there's more shares outstanding and this number grows to like 2.3 billion, when you divide 11.5 billion by 2.3 billion, this number is going to be less. And then if you jump on over to the free cash flow statement, it's not, so it's subjective how you want to look at your numbers, but you can't just look at this number and say, oh my gosh, their free cash flow is 11.5 billion. Because when you want to compare a company to a peer or a rival or to another potential investment, you want to break it down on a per share level. That way it's easier for you to make that comparison, right? Because if that company has less shares outstanding and their free cash flow per share looks better, then I would argue that company has better quote unquote free cash flow. But in the context of Disney, their free cash flow per share right now is $6.37. I think their turnaround story and the rebound is happening in real time. And let me back up, their earnings. What's important, even though they missed their revenue, is they painted a picture of a very promising short-term future. And I'll be honest with you, I think their roadmap looks pretty darn bright because their theme parks and resorts are absolutely crushing it. Now, I'm super bullish on Walt Disney. And I know that's a very unpopular opinion because I think it's easy for us to have that herd mentality and to bag on Walt Disney for their political involvement of how they depict their big cinema films. Like, I hear that argument, but when I look at Disney, separating my feelings and emotions, and I just look at them as an operation, dude, I'm so freaking bullish. Not only do they have resorts and parks that I love, the hotel industry is a cash printing, oh my gosh. If they separated the business and did a spinoff for just their parks and resorts, I would invest into it. Hands down. But they also have a streaming line of business, and they also have intellectual property of so many different characters, film franchises, and I think Disney's marketing sells itself, right? The happiest place on earth. Now, if you have young ones in your family, you probably understand what I'm saying. But if you're old and grouchy and you hate them because of their political involvement, obviously what I'm saying goes right out the window. But that is one thing that personally I hope that they stop with. I understand why they're doing, I guess, pushing the boundaries of what they want to portray, like their message in their films, but sometimes it goes way too far on one side of the spectrum, and it offends the entire other side of that spectrum. And so you alienate the box office. You're missing potential revenue from 30, 40, 50% of the people that are going to be boycotting because of the political messaging. So I hope they stop that. But anyways, why is their roadmap looking bright? So their theme parks and resorts right now, absolutely crushing it. All around the world, everyone is trying to go to Disney, especially because it's summertime. So I'm guessing their next earnings report is going to be even crazier. But they also added 1.8 million subscribers to Disney Plus. So if we click over here and go to metrics, and do they have a subscribers growth? Take a look at parks and experiences. Revenue went up by 2.7%. Entertainment growth, 46.6%. I'm guessing that's where I'm guessing this is where they put the subscribers of Disney Plus and all of their different streaming platforms. Do they? Oh, okay, right here. So, do you see how since, I don't know, 2024 of last year, look at the growth of ESPN Plus. And if you don't know what ESPN is, it's basically like the network and channel to go to for everything and anything to do with sports. Disney Plus, look how many members they're running with right now. My goodness gracious. The growth of that is 10.7%. ESPN, 4.4% year over year. Even Hulu, even freaking Hulu is growing. They're streaming. Because think about it like this. If Netflix, all they have right now is a streaming software and a platform, right? Netflix. And if their PE is a 51, what I'm trying to say is, why can't Disney be in the exact same ballpark as Netflix? Because Disney right now is at a 17.6 with all this promising lines of business in their portfolio. It just doesn't make sense to me. And I guess there are certain things that are weighing them down, right? I think a lot of us associate the streaming wars as like a shiny, flashy thing, but come to find out, what's happening is the people that used to pay for the cable services are now just switching over to the streaming services. So you're not really making new revenue, if that makes sense. So I get that part. However, I think they're opening up the doors for that Disney Plus platform and, I guess, infrastructure to be available worldwide, including Asia, South America, Europe. So I do think their revenue potential has upside for streaming. But, oh yeah, I wrote in my notes right here. And Disney's ESPN is slowly, right? They're becoming a one-stop shop for the upcoming NFL season because they just acquired the NFL Network, the NFL Red Zone, and the NFL Fantasy. And not only that, they're also doubling down on WWE, which as a kid I used to freaking love WWF, but I think now it's called WWE. It's where a bunch of guys get butt naked. Well, not completely naked. They wear like a Speedo and they wrestle each other. And I think that's where my body dysmorphia probably originated, seeing those big muscular dudes. I used to be a bodybuilder up until I was like 20 years old. I mean, now I just do calisthenics, but anyways, they're going to be hosting all of WWE's biggest live events on ESPN. And that's going to be exclusive to ESPN. And I think that's going to be a huge revenue source. Plus, I don't think you guys understand how popular American football is in the US. And to have all of those different NFL platforms and outlets to be only on ESPN, I'm pretty bullish. And speaking of which, they also increased their guidance for the rest of the year. All I'm going to say is don't sleep on the mouse. And if they do go back on a sell-off below $90 or so, I'll probably enter them and open up a position. However, I'm just going to monitor them. I do think it's a good value right now at 17.6 PE, but I do think there's a lot more room to fall if the market sentiment is still negative towards them. And the last company that I want to talk about before we talk about the upcoming week is McDonald's, the Golden Arches. Their earnings, pretty good. They beat on the top and bottom line. So when we say top, we're talking about this right here, the revenue. They beat on the expectations for the revenue by posting $6.8 million in a quarter. By the way, McDonald's is probably my most favorite real estate company. I think we all associate them for their burgers, but they own a portfolio of the most expensive real estate in Paris, in Berlin, in New York City, in Los Angeles. Love them. And they beat on the bottom line, which is obviously right here, earnings per share. The same store sales in the US increased by 3.8% year over year. I wonder if you can see that over here. No, they don't show that over here. But it increased by 3.8% year over year in the US. And in China and Japan, the same store sales growth was 5.6%. So they're growing here domestically, but also internationally. And the leadership team hinted at the fact that for the second half of this year, they should post an even stronger performance. So I think the growth story for McDonald's, it's looking pretty good. However, I think the only negative is they did mention that their target demographic, which is lower income customers, well, they have decreased their foot traffic in a McDonald's year over year. So that is a yellow flag to go up, but they are making more revenue from the middle class and upper class, which is kind of crazy. Past 5 years, a company as old as McDonald's up by 49%, and if you factor in the dividends, it's a pretty good thing to see. I am invested into McDonald's, so pretty happy camper, and I'll say it here. Do not buy into McDonald's when they're above $300. For me, I only dollar cost average and pick up shares of McDonald's once they hit below $275. I think below $275, easy buy. But when it's above $300, I think the upside to their inherent worth is just, it's too close to their ceiling. But when it's below $275, you can almost guarantee that they're going to bounce back up to $300. As you can see, every time they reach a high, they sell off, and then they get right back to it. And so I personally like to buy into them when they're right here, when they're right here, when they're right here. And as of right now, the new floor for me is about $275. So if they hit $275, I'll pick up a share or two. And for this upcoming week, we have some big names in the restaurant space, like Red Robin, as you can see dead center on your screen, Cava, and Brinker International. I believe that's the parent company of Chili's. But also in the grocery aisle, like Flowers Foods on Friday, which is a company that I do own a very small handful of shares of. And then, of course, I think on Monday, some of you might be looking at AMC, but the most of Wall Street is going to be looking at BigBear.ai. And the earnings will either send them soaring or crashing. No in between. I know that's a hot take, but I think if their earnings is spectacular, I think the real possibility is that they will end the day at around $9 or $10. If they poop their pants and say, I don't know what happened, and they report losses and they report negativity, I think it's going to crash all the way down to $3 or even $4. I know, that's a hot take. Now, if that's said, let's jump on into each day and take a closer look at all of the companies that are reporting, and I'll give you my thoughts and opinions. And then if you stick around to the end of the video, I'll be giving you some announcements and things to come for the channel. All right, let's get into it. And to kick things off on Monday, August the 11th, we got Monday.com, my preferred project management software as a service company, but they're all the same. Asana, Trello, whatever you use, they're all the same. I don't think they have an economic moat whatsoever. And there's Aon, which is an HVAC company that I covered in the HVAC industry breakdown. I'm actually going to be putting them on my radar. If they do dip below 75, I'm jumping in. When I say below 75, I'm saying around 74, 73 bucks. This is a company that has made that hard pivot into catering and servicing the data center Boom. Because believe it or not, data centers, they run hot. And you got to make sure that all of the hardware and infrastructure stays cold. And as you can see, their growth story is pretty remarkable. Even through the pandemic, despite the supply chain constraints, they still grew. And the reason being is that they make all of their stuff here in the US. So tariffs and whatnot, they're not really going to have that big of an impact on Aon. But let me see. I think Monday was also Big Bear, right? Scrolling down, is there anything? Archer Aviation, the drone company. Let's see. Where is Big Bear? All right, after scrolling down for a bit, there they are. $2 billion market cap. The expectation for them, their revenue is supposed to be $40 million. A growth of 2.4% year over year. That's the expectation for them? Bro, that is so low. The bar is set so low. So for the past, their Q1 2025, they posted $34 million. That's it. Unlike Palantir, you can see that Big Bear is kind of inconsistent with their quarter growth. However, when you break it down annually, yeah, their numbers do look pretty similar, right? Except fiscal year 2023, relatively flat, $155 million year over year. This is the company that I was referencing earlier that I think might have a trajectory and a growth story similar to Palantir based on what it is that they do. Now, I made a deep dive and an analysis video covering them. I'm neither bullish nor bearish towards them. I think this is a company that might have a bright future, but I think it's one of those show me. Like, show me what you're all about, post some good numbers, and once you do, I might buy in. And as I mentioned earlier, after they post their earnings, I think right now they're $7. After they post their earnings, you heard it here first. I can't tell the future, but this is a very volatile stock. Their average trading volume is 87 million shares exchanged per day. A $2 billion market cap. They don't even have a PE ratio because this is an unprofitable company. Take a look at their EPS, negative 93 cents. They've never been profitable in their operating history. They're either going to go down to $4.50 or $9. I'm calling it. And according to my technical analysis, their upper Bollinger Band is around that $9 mark. That's why every single time they flirt with it or get near it, they quickly sell off and they drop right back down to like 6 or whatever, at least for the past 45 days. Wow. Past 1 year, up by 500%. So you can see why Big Bear is on my radar, right? I do want to keep an eye on them because if there is a buying opportunity, I do want to jump in. And then jumping back on over to what else we have on Monday, I think we were at $2 billion market cap, right? Big Bear, Plug Power, Rare Earth. Yeah, it looks like all of the metal and mineral and mining companies are going to be reporting next week, which is going to be make or break for them. AMC. Dude, this is a company that I really want them to be successful, but I think their business model, it's kind of like buying into a physical newspaper printing company going into the 2000s. Like, their business model is just doesn't make sense for 2025. And it breaks my heart because I love going to a physical movie theater. But between you and me, it's been like 3 years since I've been to a movie theater. So, and that's on a very anecdotal level. So I can't imagine other consumers and customers that are probably just watching content from home, right? You just pay for the streaming and you watch it in the comforts of your own home so you can just watch that movie butt naked. And during the whole meme stock frenzy during the pandemic, dude, they were $592 a share. That is absolutely crazy. I think this is one of those companies that had a short squeeze. I think the other one was like Bed Bath & Beyond, and obviously GameStop. But I will not be interested at all, no matter what happens, good or bad, not on my radar. I don't really care. Because As a value investor, that's also a dividend investor, I like to only buy into high quality companies. And AMC, like I love them as a service, but as an investment, they're low quality. And I know that sounds mean, but it's just, it is what it is, right? Let's move on. I don't want to spend any more time talking about AMC, a freaking meme stock. There's Owens & Minor. They make hospital supplies and tools. Anything else on Monday? I feel like Big Bear is the only one that we should really be focusing for that day. GoPro. I still can't believe they're a publicly traded company. HF Foods. I don't think there's anything else to... Now we're into that micro cap. If you buy into a stock where their market cap is $7 million, the swings, the volatility on that is going to be absolutely bonkers. I wouldn't recommend it. So when we talk about like quote unquote best beginner stocks, you want to stick with the big boys, the big blue chip companies that neither swing high or low, that are stable, reliable, and are high quality. So another way of saying beginner stocks are also known as high quality stocks. Do not play around with micro caps. I don't even know you, and I'm trying to look out for you. The micro caps, that's essentially where you burn your money. It's gambling. It's a casino slot machine. We have the Southeast Asian Amazon right here. Their competitor would include like the Chinese varieties and flavors, but also the Korean Coupang. This one, not too interested in because I don't really know too much about Singapore, Malaysia, Indonesia, that market, although they do have a huge population. CoreWeave, this is one of the huge... Didn't they just IPO? I could be wrong, but I think they just IPO'd. Yeah, they just IPO'd back in March. They're up by 223%. Now, past wisdom says never buy into an IPO, but I feel like in 2025, buying into an IPO might not be the worst idea, especially if it's a very high quality company. In that conversation, like Reddit, they just IPO'd as well, and they're up by 533%. Some people might be like, oh, don't buy into them. They're too expensive. Yeah, tell that to Reddit, $215. So for me, I think I'm going to revise and modify my own philosophy about avoiding IPOs. If it's a high quality company in question, I think I'll entertain the idea of jumping in if their financials make sense. If they're unprofitable, if they're burning through cash, they have way too much debt, their growth, like their revenue is inconsistent, then obviously I'm not going to be jumping in. But anyways, let's see. Smith Foods. Dude, this company is headquartered in the state of Virginia, where I was born and raised. And I think it was like, is this near Norfolk, Virginia, or is this near Richmond, Virginia? I have to answer my own question here. Based in the U.S., blah, 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 blah. Smithfield, Virginia, 757. So it is near Norfolk, Virginia. This is a company that makes a lot of those, what is it, like those big chunks of ham? I'll be honest with you, I'm not exactly too bullish about that. However, I did have some sandwiches with Smithfield ham. It is pretty good. It's sweet. I think they add a lot of sugar and honey in it or something. Pretty good food product, but as an investment choice, I mean, right off the bat right here, not interested. In 2013, their revenue, their top line, mind you, this is 12 years ago. And when you jump back to the present tense, we're talking about $14.4 billion. They're just dead in the water. It's not moving. It kind of reminds me of this company right here that I truly think, that I truly think is a yield trap. Because when we think about Western Union and we look at their dividend profile, it's like, oh my gosh, this looks amazing. Until you take a look at their financials, and it's just, here, I think it's better to look at it visually. Since 2015, it's just been declining year over year. They're dying a slow death with 1,000 little paper cuts all over them. Definitely a company that I would not want to invest into. And if you take a look at their total return past 5 years, negative 58%. So Smithfield and Western Union, I would argue, not worth it. And Cava is reporting. See, I visited the U.S. a few months ago, and That's one of my regrets. I mean, I ate out at Chipotle a couple times, but I should have eaten that cava because I really want to know what the hype is all about. Some people are, saying, oh, this is going to be the next Chipotle, the Mediterranean healthy version. But it's like, is it true though? Right? I'm a big food kind of guy. And I guess the next time I visit the US, I'm definitely putting cava on my itinerary. Definitely want to check them out. Got H&R Block, the tax services, I guess, firm. Anything else that's crazy here, guys? Webtoon. This is a Korean cartoon company that posts weekly, I guess, I don't even know how to describe Webtoon. I'm not really into anime or manga or any of that. In Korea, it's called manhwa. But basically, they post new episodes of like comic book. I don't know if that's the right word. And it has like a cult following. But I don't know if this is ever going to go mainstream, if that makes sense. Because I think anime is kind of like best in class and the golden standard when it comes to like that type of cartoons. I don't even know what I'm saying. I'm not really a fan, which is so weird because I live in Japan and I have access to buying anything I want related to anime or manga, but I'm just not into it, which I guess time will tell if I'm going to regret that one day once I move out of Japan eventually, but I don't know. If you're into anime, manga, manhwa, put me on. Leave a comment. Let us know. Webtoon. Are you bullish, bearish? Me personally, I'm like lukewarm. It's kind of like the water description that I talked about earlier. I don't really have strong feelings. I'm just like, okay, cool. And obviously, I don't want to look at any companies that are less than 100 million market cap. It's too small. And then to kick things off on Wednesday, August the 13th, we have Cisco. I'm actually invested into them, funny enough. The revenue growth should be $14.6 billion for the past 90 days. Growth is 7%. Actually, those expectations are kind of high. Let's see. Let me close some tabs up here. It's getting a little wonky. Currently $71.79. They are a part of my portfolio. Did I already say that? Which I think is pretty funny. Because the investing thesis at the time is, hey, some of these ancient, old school tech companies, they find a way to stay relevant and to be sticky with their customer base. And I think one of my coworkers quit and hopped on over to was IBM. And I was like, why IBM? And then she put me on. She made me aware that IBM is making a huge impact in AI, cloud, and all this stuff. And I was like, wait, IBM? And so I started to investigate Cisco because for the past two corporate companies that I used to work for, both of them were Fortune 20 companies, we used Cisco as our network security in order to log in for our credentials and everything. So I was like, wait, so Cisco, they seem to be doing business with all of the big players. And then once I started looking into them, I was like, hey, this is actually a pretty solid company. I mean, their max performance, crying out loud, is 86,000%. But I will say this, if you did buy into them during the dot-com bubble crash, when all those different www.xyz companies were going public, at $74, you're still in the red after all these years, 25 years later. But if you're anything like me and you bought into them around, I can't remember if I bought into them here or was it over here. All I know is that I'm up in the green by a huge chunk. Pretty happy camper. And they're a tech company that has a respectable dividend yield. And I say respectable because Microsoft, Google, and Apple, their dividend yield is almost comical. 2.2%, but the growth rate is really small. We can do better than that, guys. But anyways, let's take a look at their financials real quick. It seems to be pretty stagnant. Wouldn't you say so? Funny enough. And then let's take a look at their earnings per share. My goodness, this is horrific. Negative 17.3%. It's probably because they did an acquisition or something. I need to revisit Cisco and do my homework to see what the heck is going on, because I should probably sell out of them. I mean, if they continue their growth story and their turnaround story, maybe I'll stay in. But depending on how this earnings go, I might pull the trigger and just sell out of them while I'm in the green by a crap ton. So there's that. And then there's PFG. They're headquartered in Richmond, Virginia, I believe, and they do wholesale food products for restaurants and private food label manufacturers. Let me see. Yep. And then where are they headquartered? Richmond, Virginia. Yes, sir. This is a company that I actually bought into during the pandemic at like 40 something bucks, and I sold them at 65. And I kind of wish I held on to them because I would have been up by almost 200%. But at the time, I was like, it's a high quality company going through a temporary sell-off, and food distribution is never going to go away. However, I think the reason why I sold out of them is if I click here, I don't think they pay a dividend. Yeah, I think that's one of the reasons. I was like, they don't pay a dividend. I think I can use my capital and put it into other dividend-paying compounders. So PFG is a pretty good company. I think their only real rivals, trying to think off the top of my head, would be, let me see, UNFI is another one, but they're going through a storm right now. They're headquartered in Minneapolis, or Eden Prairie, Minnesota, maybe? Let me see. Go to profile, jump on down over here. This is a company that I almost joined. However, they're actually not headquartered there. My bad. I thought they were in Minnesota. Well, I guess the office that I interviewed for was Minnesota. I almost joined them, but it just didn't work out. And this is a company, unlike PFG, even though they have the exact same business model, they're struggling right now, as you can see. During the pandemic, they were absolutely crushing it. And that's when I was interviewing for them, because I was like, hey, this company has a pretty good future. And I guess you could say I dodged the bullet, because I think they're going through I looked into them like last year to just be like, I wonder how they're doing. And they were going through a tough time. And it doesn't seem like anything has changed. And then there's Brinker International. This is a company that has defied the odds in the restaurant category. They're up by 411%. That's why I tell you, you can find dividend compounders with cheese in any sector and industry. There are hidden gems across the stock market. You don't have to just be monitoring AMD, NVIDIA, or Microsoft. There's hidden gems and beauty across the board if you just look in the right places. And I think a huge component of their success has been Chili's. They've just been crushing it with their value menu of like $10 to have this plus an appetizer. And a lot of people have been raving about them on social media as well. Me personally, I think Chili's is good. I like getting their burger, but I think this one, oh my gosh, Maggiano's. You guys know how I feel about Olive Garden. I know it's not Italian food, but my goodness gracious, you take me to Olive Garden, I'll do anything for you. Maggiano's is better than Olive Garden. I think it costs a little bit more, but Maggiano's, man, their spaghetti, oh my goodness gracious, so freaking fantastic. But if we take a look at their financials, this is a pretty beautiful story. I love the restaurant industry. I think it's one of the best beginner sectors to invest into because it's easy to understand, and eating out is one of those things that we as humans just love to do. And it's not hard to tell which ones are successful and which ones are struggling. You just got to go out during the lunch rush hour to see which ones have a line out the door, which ones have terrible reviews on Google, and by looking at their financials, right? So Brinker International, I think the ship has sailed. I don't think I'll ever have a chance to buy into them, especially for the price that I want, considering they were freaking $58 at one point last year, but now they're just crushing it. So I guess that ship has sailed. I did want to buy into them, I think somewhere around this point. I was like, hey, if they hit around $40, I'm in. And I think they dipped down to like, what is this? Sorry, my mouse is so sensitive. Oh my gosh, my mouse, $59. It never got to my price range. And that's the thing about me, I'm super patient. I never really experience FOMO anymore. I used to when I first got introduced to the stock market. But if a company does not reach my buy price, I'm okay with just waiting it out. And I think I have that mentality because I have over 100 companies on my watch list. Meaning, if I miss the train ticket and I can't go on the ride, then I'm like, that's okay. There's 99 other ones, and then I end up just replacing the one that has sailed with another company. So Brinker International. Anything else that's... Hold on. It's Wednesday, right? Yeah, Wednesday. I've been filming for a hot minute now, so my brain is getting a little fried, and that food coma is giving me some cramps right now. My gosh, I think after filming this, I might have to do a workout or something. Work off some of the calories that I digested. By the way, I feel like people talk about how like Americans don't have culture and our food sucks. But it's like, have you ever had an American breakfast with some greasy bacon, scrambled eggs with some butter and cheese on it, some tater tots, some mashed potatoes? Dude, sign me up. I think American breakfast probably takes the cake. Like Japan, the breakfast here it's not my cup of tea, man. They have like a small bowl of rice and some fish and some miso soup, and that's the way they start their day in the traditional way. But for people that are my age, mid-30s, maybe like up to their 40s, dude, you know what their breakfast is? I kid you not. One slice of bread, and they market it as Texas toast. They have one piece of bread for breakfast. That's it. And I'm like, bro, I can't do that. I side-eye people. I'm like, that's what you do? And it's not because they're trying to save money or anything. They just find that delicious, convenient, and fast. But I don't know. I guess that's how you know I'm an American. I prefer my greasy food, man. Anyways, it looks like as I'm scrolling down, it seems to be the small caps that we shouldn't really be paying attention to anyways. So, mind you, the people that do like investing into these kind of companies, they tend to be like swing traders, day traders, because these ones have such beta volatility that you can make a crap ton of money or lose your entire bank account in one transaction. For me and my risk tolerance, I'm not really interested in swing trading or day trading. And then Thursday, we have a semiconductor equipment manufacturer, Applied Materials. I think Lam Research and ASML reported not too long ago too, and I think they went on a sell-off. So I wonder how Applied Materials is going to react. I think they also went on a sell-off on the news with ASML with their, I guess, guidance of like, hey, we don't know how tariffs are going to impact how the rest of our year. Actually, I want to touch base on how Lam Research went. Let's see. After their earnings, they went up by 5%. So it looks like they actually had a really good earnings, unlike ASML. I guess they didn't use the word tariff. Which I understand why their leadership did, because I feel like that's the scapegoat right now, right? You could blame everything on tariffs, and you can just hide any operational deficiencies because of tariffs. And I think I need to make a video about this, because I can talk all day about how the current administration, I think they're giving us a gift unintentionally by, with all these threats of tariffs, day in and day out, week over week. I think the stock market just, they don't know what to expect. And Wall Street, hedge funds, and investors hate uncertainty. So I feel like we get buying opportunities almost every 2 to 3 weeks. Like we see significant dips and pullbacks, and the volatility is it's kind of in our favor. So that's why I think for the next 3 years, I think we're going to see more pullbacks. Like right now, VU, the Vanguard's version of the S&P 500 index ETF, it's 585, but I do think we're going to see more pullbacks and dips down to like 460, 450. You can quote me on that. I think it's going to be just as volatile for the next 3 years. And for me, I think that's a good thing. To be able to pick up high quality companies on the dip because of speculation, I think it's a good thing. I don't know if the current administration is doing that intentionally, causing sell-offs and fear in the stock market so the politicians can buy these companies, but I'm trying to go right in with them. So I'm like, wait, there's nothing fundamentally changing about these companies. Like there was a lot of fear of like, oh my gosh, we make a lot of our stuff from China. We're going to be screwed. But now we're finding out there's ways to circumnavigate that. You can route it through India, the Philippines. You can route it through the UK. You can avoid those tariffs altogether. And it's business as usual, right? And I think that's why, I forgot who said it. It was like Peter Lynch, Howard Marks, maybe it was Charlie Munger. Somebody said it like, don't drown yourself with the nuances of macro environment conditions. That's out of your control. What you can control is focus on trying to find the high quality companies and buy them on the dip. Because more often than not, you should never bet against America. We will always rebound and reach a new high. And I know there's some people that are doomsday sayers like, that's not true. You guys are going to fall one day. You guys suck. That's like, dude, why are you even bothering watching this video or interested in our stock market if you believe that way? I truly think the US stock market is going to be best in class, have the best and brightest companies available. That's what's like, I had this conversation with my wife the other day. It's kind of weird how the US, out of all the countries in the world, why is it that the US has like the most innovative, tip of the spear, significant, impactful companies, right? All the big boys are headquartered and located here in the US, and all of the smartest, brightest minds, they want to come over here on a visa and work for these companies. Who am I talking about? I'm talking about Amazon. I'm talking about Microsoft. I'm talking about Google. I'm talking about Apple, Tesla, BigBear, Palantir. All of these phenomenal companies in a big quantity are headquartered in the US. So that's why I'm bullish on the US. Sure, every country I think has like one or two spectacular companies. Like Canada has Shopify. And then I think it's Sweden or Netherlands has Spotify. But I mean, the list gets smaller and smaller across the board, right? I think like each country has like one or two pretty good companies, but the US has like 1,000 good companies. Now I know what I just said probably offended some people, and that's why I'm okay with only investing into the United States of America. I don't bother diversifying by buying into small caps in India or Africa. Dude, people have been saying that for decades. Oh my gosh, India, Africa, that's the next big boom. And it's like, nah, dude, the next big boom is the boom that's in your face right now. It's the US. Maybe it's the US. Let's go. Come on. I need a sound effect right here of a screaming bald eagle, right? I don't know. If you're anything like me, then you're probably bullish about the US publicly traded companies. Anyways, let's move on. I'm sorry for that little rant. I'll get off my soapbox now. We have John Deere. We have JD.com. I did eyeball the Chinese companies for a bit, like Alibaba, JD. And ultimately, I'll say it right now publicly, I would rather invest into an undervalued, high-quality US company on the dip than the Chinese big stocks. Like, I think they are on a dip right now as well. But all else being equal, as you can see, they're at a 5-year low. All else being equal, I would still rather just buy into the US one. Because I think I have a better understanding of the landscape, the environment, and the conditions in which companies based in the US need in order to thrive and be successful. Whereas for like the Chinese ones, I don't really understand the Chinese market, the demographic, and all the different factors and variables necessary for them to thrive. Although I'll say this right now, I think one of the biggest fears that Elon Musk has is the Chinese EV manufacturers penetrating the US market. I think, correct me if I'm wrong, I don't know, don't quote me on this as a truth, but aren't Chinese EVs not allowed to be imported into the US? Could be wrong, but I think that's the case, right? And I think it's because maybe it's because they're able to produce the EV at a cheaper cost basis, a fraction of the cost. Maybe it's that it's better, right? And I think Tesla would lose their market share. I think the Chinese EVs that I'm thinking about right now, NIO and BYD. And I read this report the other day where it said for the past 365 days, globally, the best selling car globally was the Tesla Model Y. And I was kind of taken aback. I was like, wait, really? I thought it would be like the Toyota Corolla, which was number 2. And then number 3 was the Toyota Camry. And then the rest of the top 10 was all Asian cars, Honda, Toyota, Hyundai, which doesn't surprise me. But what did surprise me was Tesla being number 1. And I think there was a Chinese EV somewhere in like number 11 or number 12. Yeah. The reason why I'm talking about cars so much is I think eventually, if I ever do move back to the US, I might buy an EV. I've been eyeballing the used EV market, but it looks like the tax credit is dissolving and it's going away. So I might have to revisit that idea, because if the EV tax credit is going away, then I don't know if I can afford a used EV. Because I think you were able to write off up to $4,000, but man, it's stinky that it's going away. But whatever, I live in Japan. I don't think I'll be buying an EV anytime soon anyways. And then there's also Nice. I think I talked about this company a few times. It's an Israeli-based customer service software company that I think is super high quality, right? And I think a lot of American companies are going in that direction, which drives me up a wall. I know I just had a speech about how great Americans are, but I think the fact that we're outsourcing all of our customer service engagement overseas or to AI robots, it drives me up a wall. Because sometimes you need a call because you have a problem or you want to look into a warranty or something, and then to go around in circles, dude, it drives me up a wall. But Nice basically sells a software that allows you to talk with an AI agent. Have you ever used one of those before? Like you go to a website, it's like, how can I help you? You're not interacting with a real human, you're interacting with Nice. And if I show you their fundamentals and financials, it's just remarkable. Just take a look at their revenue. Almost every S&P 500 company does business with them. The only reason why I'm not jumping in is because of the political landscape associated with the country that they are registered in. I think there's a lot of controversy surrounding this country right now. If I scroll down and show you with this country right now, and for me, I'm like, ooh, the business itself is pretty solid. And the reason why I would invest into them despite not being an American company is that they do almost 90% of their business in the US. I think the last time that I looked at their 10K, it was something like 75%. And then they do like 15% in Europe, and then the other 10% in Asia. But because they do most of their business and revenue from American companies, I go ahead and define them as an American company. I would buy into them, but do you think that's a valid concern of like, there's a lot of pushback towards their country for what's happening currently? So for me, I'm like, oof, that's the thing. I don't really like to buy into companies that have political involvement, whether it's intentional or unintentionally. Because that in itself can push the stock price down, even if it's a high quality company. But also, I think the landscape of AI is changing so fast day by day. Nice might be made irrelevant in the future because who knows, Microsoft might be able to integrate a customer service agent into Windows 13 or Windows 14, right? Or even Google. And so I think with Nice, I think they have a really good short-term future, but in the long-term, 10 to 20 years, I think there's a lot of uncertainty baked into their future. So if they do go below 130, I think that's the point where I won't be able to resist, and I think I will pull the trigger. But as you can see, their one-year metric, the highest price and the lowest price they achieved, 137. So if they do hit 130, that means they're really... wow, their max is still 2,800%. But if they do reach below 130, that means they're really getting punished hard by the stock market and they said something, or they have a headwind that just seems way too big for them to overcome. And so maybe I don't think I'm going to put any buy orders in. I think that's one of those ones where I'm going to have to monitor their earnings to see whether or not I want to buy. And then this one is weird because I feel like they just IPO'd McGraw-Hill. It's the academic textbook company. If you went to college or university here in the US, you probably had to buy a McGraw-Hill textbook for biology or for your English composition class or for your whatever class, right? They have a monopoly. They just IPO'd. How far back? They just IPO'd in July 24th, and they're already down by negative 21%. So it goes back into that theory of don't buy IPOs, an initial public offering. Right now, they're down by negative 21%, currently $13. They do not have a PE ratio. For a company that's been around as long as they have to not have positive net income, they've been around since 1888. For me, that's a big red flag, right? For a company that's as ancient and as old as them to go public for the first time and still not be profitable, I mean, come on. Well, let me see if they ever were profitable. They were profitable in 2021, but since then, when the bar graph goes below the standard right here of the 0 of the marker, that means they're burning cash in order to run their operations. Not interested in them whatsoever. Weibo, another Chinese company. TMC, the metals company. I think they do like sea exploration for rare earth minerals and metals that are only in the reefs or in the bottom of the ocean, something like that. I could be wrong. Let me see. Nickel, cobalt, copper, and manganese products. Yeah, I got like a B in chemistry. Wasn't really my forte. Let's see. Yeah, they do it in the Pacific Ocean. So I think this is a kind of an interesting company. I think there's people that are very interested in rare earth metals and mining. For me, it's not my cup of tea, because if you're a friend of the channel, then you know that I don't really like commodities. Like, it makes sense if you invest into it, but you really have to understand when to buy and when to jump out. Because commodities like oil barrels, gold, or metals and minerals, it's one of those things that have a volatility baked in. They have natural market swings. Now, that's not my cup of tea. Because as I am maturing as an investor, I kind of like the idea of only investing into stocks that are just slowly growing consistently, reliably, like Palantir that we saw earlier. Obviously, I'm not invested into them, but to give you an example of like a super volatile company, let me think about this for a second. Oil and gas. I guess we could do like Murphy. I forgot if they're upstream or midstream. They have two, right? Murphy USA is the gas stations, which I would invest into because it kind of doubles as like a convenience store and the travel industry. But this is the one that does, I can't tell if it's upstream or midstream. I can't remember, but they drill oil. If you take a look at their financials, you'll see what I'm saying. They have natural highs and lows based on their market cycle. This is exactly what I don't want to invest into, because when the highs are high, their stock price reflects that as well. But when they go back into their low cycle, as currently right now, take a look at it. Their stock price is also adjacent to the amount of money that they're able to generate. So for the commodity space, like, I get it. I see the appeal. But unless you buy into them at their very lows of the cycles, it's a company that I'm just not interested in. I think is that fair? I guess as an investor, you don't have to be interested in every sector in this industry, right? For me, the commodities are just not my cup of tea. Anyways, let's move on to Friday. I think there was one company that was a call out, right? There's Unilever, which I love. And as an investor at Procter & Gamble, I'll say this. And it pains me to say it, but they're the more high-quality version of Procter & Gamble, because they do the exact same business segments of personal grooming, self-care products, everything in the grocery aisle, like right there, personal care, home care, foods, and ice cream. And the ice cream that I've been eating a lot because I have a pregnant wife at home, so I do eat some of the foods with her, has been Breyers. Turns out it's made by Unilever. My favorite body wash is Dove, and that's made by Unilever. And the list goes on and on. Like, Unilever is somehow, they're able to produce products that Procter & Gamble does as well, but at a cheaper price point. And then I can't tell if it's better quality, but it is the ones that I prefer. Now, since I've been living in Japan, I've been using Irish Spring as my body wash, which I believe is owned by Colgate, Palmolive. I could be wrong, but a second place for me would be Old Spice. Dude, I know, Old Spice gets a bad reputation as like, oh, it's what our grandpas used to use as an aftershave. But dude, next time you have a chance, go give it a sniff. I think they sell them at Costco and at Target. Go give Old Spice body wash a sniff. Dude, it smells so freaking good. But anyways, this is a company that I would potentially invest into, but personally, I would rather invest into Procter & Gamble. And I think one of my pushbacks for Unilever is that they're headquartered in the Netherlands, I think. Hold on, let's jump on over to their profile to figure that out. Or the UK. It's somewhere in Europe. United Kingdom, yeah. So they're headquartered in the UK. And when we compare them to Procter & Gamble, now, remember what I said. There's business and products and services that are good, but not necessarily good investments, right? I think Procter & Gamble, not only do they make good products, but they're also a good investment because they put the shareholders in mind and they return value back to us. Because their past 5 years, just for share price appreciation, is 14.9%, whereas Unilever was almost flat. But if we bake in the dividends as well, the return would be a little higher. This is one of those companies that's, I don't want to get ahead of myself, but it's a buy and hold forever. So Unilever is nice, but I would rather just buy into Procter & Gamble. And then I think the only company that is worth mentioning before I give you guys some announcements is Flowers Foods. Now, I only have a few shares of them. They basically have a monopoly on the bread aisle. I'm serious. Next time you're grocery shopping with your wife, if you get bored, walk on over to the grocery aisle, pick up some of the breads, Wonder Bread, whatever bread. It's almost all made by Flowers Foods. And right now they're in a natural cycle of being sold off with the rest of the grocery aisles like General Mills, Conagra, Kellogg's. Every single food manufacturer is being sold off. And for me, I've been doubling down and picking up shares as they're going on this massive sell-off, because if you look at their full history, they always have these little corrections, but they always find a way to go back to a new high. Like right there, right? You bought into them and then, they went on a sell-off and then they recover. And then they go on a sell-off, and then they recover, and they reach a new high time and time again. And my favorite thing about Flowers Foods is that they don't just stick with their portfolio. They're a serial acquisition buyer. I don't know if that's a word, but they buy out the competition and they grow their economic moat. So whenever there's a new startup that sells baked bread, they just come in and buy you out. They just don't want to deal with you. And so I love them. I like them. Now, I don't even have more than like 10 shares, so it's nothing to write home about, but definitely a nice little dividend compounder. The payout ratio is getting a little high, so I'm hoping they're able to bring that down by posting better earnings per share. Actually, we need to look at a 6% dividend yield, 4% dividend growth. You'll have to see it. Let me see what the expectation is for them, for their earnings. So the expectation is for their revenue to grow by 3.5%, and the EPS is supposed to go down by negative 19%. So that's not going to help the cause of their payout ratio and their dividend. But I'm assuming the EPS, if anything changed, because I just did a deep dive analysis on them, they had a lot of accounting tax write-downs for acquisitions that they just made. So I'm hoping it's related to that, but yeah, it might be a buying opportunity. If they dip below $15, I'll probably increase the amount of shares that I own of Flowers Foods. I do not think bread is going to go out of style or disappear anytime soon. Anyways, friends and family, before I head out of here, I'll give you guys some announcements, some updates. So I posted my portfolio and its holdings up on the Patreon, so you guys can see what I'm invested into, the cost basis and everything. And then soon enough, if you don't want to join the Patreon, I'll also be doing a portfolio reveal on the YouTube channel itself. I'm still hashing out the details of how I want to do the weekly series surrounding that portfolio, because I do want it to be a public portfolio where you guys can see all the transactions, buys, sells, and updates. I think it would be fun. And then what else happened? Oh yeah, this past Friday, I got my first Yield Max dividends. Yeah, it hit my account and it was a whopping $2. And that's why I'm not starting that series yet. Give me some time to build up a good size to at least get like a $5 dividend, and then we'll snowball it from there and roll out the series. But I feel like with $2, I don't think it's palatable. It's not really marketable. People aren't going to click to see a $2 dividend payout, right? So let me do my thing. I'm currently slowly acquiring shares of the Yield Max ETFs at the price that I want at their very lows, because I'm a value investor, right? I'm not just going to buy them willy-nilly. So that's also on the menu. And then tomorrow, dude, I'm kind of nervous. I have my first dental cleaning in, I don't know how long, maybe 3-4 years. Getting my teeth cleaned, a little nervous. I floss every single day. My teeth are in pretty good condition. It's just, I don't know if you're anything like me. I just don't like going to the hospital to visit a doctor or anything like that, because I think I have this very toxic mentality of just suck it up, and unless I'm dying or my arm is falling off, I should not be seeking treatment. I have this toxic idea like that in my head where it's like I'm clogging up the system. There's other people who need to see the doctor, not me. I'm a healthy man. So I'm trying to get rid of that, because that's not healthy and not productive, right? And that's why I'm finally getting my teeth cleaned. Super nervous. But anyways, the next video that's going to be uploaded after this one that I've been working on all freaking week, it's going to be titled My Buy and Hold Forever Stocks. And I'm going to tell you right now up front, it's going to be pretty controversial and a lot of hot takes, because my buy and hold forever ideology is not going to be mainstream whatsoever. So that's what you can expect in the upcoming week after this one. But anyways, if you made it to the end, I love you guys. Stay safe. Good luck in the stock market, and I'll talk to you really soon. Peace.